Your savings account just lost 8% of its value. Not because you spent anything, not because the bank charged you fees, because while you slept, a machine was running. A machine that extracts wealth from workers and savers and concentrates it at the very top. And the people operating this machine are the ones who told you it was designed to help you. March 2022, inflation hits 8.5%, the highest rate since 1982. Your checking account pays you 0.03% interest. The difference, 8.47%, that's the rate at which your purchasing power evaporates. In 12 months, nearly $1.8 trillion of purchasing power vanished from American bank deposits. Nearly $2 trillion, just gone. The Federal Reserve knew this would happen. They had the data, they saw the numbers, and they kept interest rates at zero anyway. This isn't an accident. This is a feature. Many economists argue that negative real interest rates represent one of the most efficient wealth transfer mechanisms ever devised. No legislation required, no congressional vote, no public debate. Just a quiet mathematical certainty that money sitting in ordinary accounts loses value, while assets owned by the wealthy appreciate. Here's how it works. You have $100,000 in savings. Inflation runs at 5%. Asset prices also rise by 5%. Your $100,000 is now worth $95,000 in real terms. But if you owned a house worth $1 million, that house is now worth $1.05 million. Your net worth increased by $50,000, while someone with cash savings lost $5,000. Same inflation rate, opposite outcomes. This is what analysts call the portfolio channel. Research from the St. Louis Federal Reserve confirms what many suspected but few wanted to acknowledge. When inflation surges and deposit rates stay near zero, every single advanced economy in their study showed negative realized returns on demand deposits. Every single one. The purchasing power of money in checking accounts declined across the United States, Japan, Australia, Denmark, Norway, New Zealand. The pattern was universal. A 2006 study published in the Journal of Political Economy found that even moderate unexpected inflation substantially redistributes wealth among households. The researchers traced exactly where the money goes. Wealth transfers from richer, older households who hold bonds and cash to younger middle-class households with fixed-rate mortgages. That sounds equalizing. That sounds like maybe inflation helps the middle class. Until you look closer, because there's another side to this equation. Who holds the majority of government debt? Who owns the bonds? Not the middle class. Pension funds, insurance companies, foreign governments, large institutional investors. Between 1945 and 1991, the nominal value of U.S. government debt grew, but inflation and economic growth caused the debt as a percentage of GDP to fall dramatically. Debt was inflated away, and every time that happens, it represents a transfer from bondholders to the government and future taxpayers. But here's what they don't tell you. The same mechanism that theoretically helps middle-class borrowers also devastates middle-class savers. And in an aging society where more households depend on savings for retirement, the inflation tax becomes increasingly regressive. The official story says quantitative easing was necessary to prevent economic collapse. Central banks had to purchase assets to inject liquidity into the financial system. They had no choice. Interest rates were already at zero. Something had to be done. But a 2012 Bank of England report revealed something remarkable. Quantitative easing benefited mainly the wealthy. 40% of those gains went to the richest 5% of British households, not the bottom 20%. Not the struggling middle class. Federal Reserve Bank of Dallas President Richard Fisher said it plainly in 2013. Cheap money has made rich people richer, but has not done quite as much for working Americans. British Prime Minister Theresa May was even more direct in 2016 when she criticized quantitative easing for helping those on the property ladder at the expense of those who can't afford to own their own home. These aren't conspiracy theorists. Research published in the Oxford Bulletin of Economics and Statistics in 2023 found that for the majority of euro area countries under review, expansionary quantitative easing via asset prices leads to net wealth inequality increases. The study used wealth indicators sensitive to changes at the tails of the wealth distribution. Translation: quantitative easing makes the rich richer and pushes the wealth distribution further apart. Here's the mechanism. Central banks purchase government bonds and other securities. This drives up the prices of those assets. Who owns those assets? Predominantly wealthy households. A study from the Institute for New Economic Thinking analyzed the impact of quantitative easing on income distribution through 3 channels. The finding, while employment changes and mortgage refinancing were equalizing, these impacts were swamped by the large disequalizing effects of equity price appreciations. Stock prices soared, real estate values climbed, bond portfolios gained, and 1/3 of households in the study held neither housing nor financial wealth. They received 0 benefit from asset price inflation. 0. They experienced only the downside. Higher costs for housing, higher prices for goods. Wage growth that couldn't keep pace? The New York Federal Reserve published research showing that quantitative easing reduced inequality within the bottom 90% by lowering unemployment. But it widened the income gap between the top 10% and the rest by raising profits and equity prices. So if you're in the bottom 90%, you might see some benefit. But the top 10%, they captured the lion's share. This brings us to 2008, the financial crisis. The moment when the wealth extraction machine went into overdrive. Treasury Secretary Henry Paulson proposed a 3-page plan: buy troubled assets from failing banks, inject capital into the financial system. Congress authorized $700 billion, later reduced to $475 billion. But the official numbers tell only part of the story. MIT economist Deborah Lucas calculated the true cost of the crisis-related bailouts, not the cash accounting, the fair value accounting. Her finding: about $498 billion, 3.5% of GDP in 2009. And who were the main beneficiaries? The largest direct beneficiaries were the unsecured creditors of financial institutions. Large institutional investors, other banks, pension funds, insurance companies. The University of Michigan analyzed whether banks paid a fair return to taxpayers on TARP investments. They compared TARP returns with returns earned on securities of similar risk in private markets. The conclusion was stark. From a purely risk-return perspective, the return on TARP securities was not fair. The gains from economic recovery were captured disproportionately by recipient banks. But there's another layer. A subsidy that rarely appears in official accounts. The World Bank analyzed what they call implicit government guarantees. Before the financial crisis, the subsidy to large banks amounted to about $4 billion per year. During the crisis, $60 billion per year. This is the too big to fail premium. The market knows the government will bail out systemically important institutions. So these institutions borrow at lower rates. They take bigger risks. They operate with implicit government insurance. And that insurance has a cost. A study from the University of Chicago examined enforcement patterns and worker flows between regulatory agencies and the financial industry. They found a consistent relationship. Stricter enforcement correlated with certain migration patterns. Less strict enforcement correlated with others. And over the past 25 years, retention rates for regulators have fallen dramatically. 88% of those who started working in regulation in 1988 were still there 3 years later. By 2008, only 64%, the brightest minds, were leaving for private sector jobs at the institutions they once regulated. This is what researchers call the revolving door. Over a 5-year period, former SEC personnel filed 789 notices disclosing their intent to represent outside companies before the agency. Sometimes within days of leaving the SEC, more than half came from the Enforcement Division. The division responsible for punishing financial misconduct, research published in 2021, found that the top 5 financial companies concentrate around 80% of revolving door movements. This isn't a broad industry phenomenon. This is the biggest players capturing regulators. Studies of patent examiners at the U.S. Patent and Trademark Office revealed that examiners grant considerably more patents to the firms that ultimately hire them. The researchers concluded the most likely explanation is that examiners are captured. Their leniency lowers the quality of patents coming out of the agency. The OECD and numerous research organizations have cited the revolving door between Wall Street and Washington as one of the main causes of the 2008 financial crisis. Wall Street veterans occupied key positions in government. Strong personal connections developed between senior bankers and high government officials. The so-called too-big-to-fail banks gained privileged access to decision-makers. And these relationships promoted the Wall Street worldview in the political world. But here's the crucial insight from recent research. The revolving door doesn't just work one way. It's not just regulators leaving for industry jobs, it's industry veterans entering government with what researchers call cultural capture already embedded. A study in Canadian public administration interviewed public officers whose career paths included revolving door scenarios. The finding, cultural capture, occurs when new public officers come from the same private sector now within their purview. Based on allegiance to their former industry, lobbying is exerted from within. No explicit agreements necessary. No corruption in the traditional sense. Just shared worldviews. Shared assumptions. And despite clear irregularities and conflicts of interest, most of those interviewed did not believe in tightening rules. They preferred vigilance. Self-regulation. The same approach that failed before 2008, the pattern repeats. Crisis emerges. Government intervenes. Costs are socialized. Gains are privatized. Then the cycle begins again. 2023, the largest banks in America report record profits. Meanwhile, research from Stanford Institute for Economic Policy Research reveals something most people never consider. The source of inflation matters. When inflation comes from the Federal Reserve, cutting interest rates, young and middle-aged college-educated households lose the most. When inflation comes from oil price shocks, the pattern reverses. Less educated households suffer more. Same inflation rate, different causes, completely different victims. This is what makes the wealth extraction machine so effective. It's not simple. It's not obvious. Consider what happens during a monetary expansion. The Fed cuts interest rates, asset prices rise, stocks climb, real estate appreciates. Who owns these assets? Disproportionately, the wealthy. Research shows that monetary inflations have distributional effects because of differences in households' asset portfolio decisions, not because of spending patterns, not because of wage dynamics, because of who owns what. Young, college-educated households often have mortgages, but also hold substantial financial assets. Middle-aged, wealthy households own diversified portfolios, heavily weighted toward equities. Each group experiences the same inflation differently, based entirely on balance sheet composition. And the central bank knows this. The research exists. The models account for it. The European Central Bank studied how quantitative easing affects income and wealth inequality across different euro area countries. They found that 1/3 of households holds neither housing nor financial wealth. 1/3, these households are not directly affected by quantitative easing through the asset prices channel. They receive none of the upside, but they face all of the downside. Higher housing costs, increased prices for goods and services, stagnant wage growth. The study used microsimulations based on household finance data for the majority of countries reviewed. Quantitative easing via asset prices leads to net wealth inequality increases when measured using indicators sensitive to changes at the tails of the distribution. The Gini coefficient, often cited by central banks, pointed to an equalizing impact. But wealth indicators that capture concentration at the very top told a different story. The wealthiest percentiles pulled further away, and the methodology matters. If you measure inequality using metrics that downplay concentration at the top, you get one answer. Researchers in Japan found that a decade of unconventional monetary policy widened income inequality, especially after 2008, when quantitative easing became more aggressive. The mechanism, largely the portfolio channel, asset owners benefited. Non-asset owners fell further behind. But what about the employment argument? Central bankers consistently point to job creation as the equalizing force. Easier monetary policy promotes employment. Unemployment falls, workers benefit. This is true. The New York Fed study showed quantitative easing reduced inequality within the bottom 90% by lowering unemployment. But the same study showed it widened the gap between the top 10% and everyone else by raising profits and equity prices. So the bottom 90% might gain relative to each other, but they lose relative to the top. And when you consider that the top 10% already owned the vast majority of wealth, this means the absolute gains are concentrated upward. A worker who finds employment might see their income rise by $20,000. Significant for them. But a wealthy household might see their portfolio rise by $500,000. Both benefit, but the distribution of benefits is nowhere near equal. The Institute for New Economic Thinking attempted to quantify this. They analyzed 3 impact channels: employment, mortgage refinancing, and asset appreciation. Employment and refinancing were equalizing. Asset appreciation was The conclusion, quantitative easing, was modestly desequalizing, despite some positive impacts. Modest is the key word. Not dramatically desequalizing, not catastrophically desequalizing, just consistently, measurably tilted toward, concentrating wealth at the top. This brings us to a crucial observation from research on inequality and monetary policy. There's a fundamental asymmetry in how different groups experience policy changes. When the Federal Reserve raises interest rates to fight inflation, savers benefit. Returns on deposits increase, bond yields rise. But asset prices fall. When the Fed cuts rates and implements quantitative easing, the opposite occurs. Asset prices soar, savers suffer, the wealthy benefit. But here's the pattern that emerges over decades. The average period of low rates and quantitative easing lasts far longer than the average period of high rates and quantitative tightening. From 2008 to 2022, interest rates remained near zero for most of the period. Asset prices climbed relentlessly. Yes, savers suffered, but the wealthy accumulated unprecedented gains. When rates finally rose in 2022 and 2023, asset prices corrected. The cumulative effect over the full cycle. Massive wealth concentration. Research tracking wealth percentiles from 2007 to 2019 shows this clearly. The top 1% of households saw their wealth grow far faster than inflation. The middle 50%. Their wealth grew but couldn't keep pace with asset price inflation. The divergence isn't subtle. Now consider the political economy. Who influences monetary policy? Who has access to central bankers? Who gets heard? Research on regulatory capture provides uncomfortable answers. The revolving door ensures that the people making policy either came from or will go to the financial industry. Cultural capture ensures they share the industry's worldview. Information asymmetry ensures the industry possesses far more data and expertise than regulators can independently develop. Campaign finance ensures elected officials who oversee central banks are responsive to financial sector interests. Lobbying ensures those interests are communicated effectively and consistently. The financial sector spent over $1 billion on lobbying in 2020 alone. No corruption in the traditional sense, just structural advantage, just institutional capture, just a system where the regulated have overwhelming influence over the regulators. The consequences compound over time. Consider wealth inequality trends in advanced economies. Since the 1980s, the share of wealth held by the top 1% has grown dramatically. In the United States, research tracking income and wealth inequality from 1949 to 2016 shows the pattern clearly. The top 1%'s share of wealth has climbed steadily. And the mechanisms driving this aren't mysterious. They're documented in academic literature. Asset price inflation disproportionately benefits asset owners. Low interest rates transfer wealth from savers to borrowers and from creditors to debtors. But in an economy where the wealthy hold diversified portfolios, they capture gains from both rising asset prices and favorable financing costs for investments. Negative real interest rates punish cash holders. Quantitative easing inflates asset prices. Regulatory capture ensures policy frameworks favor financial sector interests. And the revolving door ensures continuity of perspective across political transitions. These aren't separate phenomena. They're interlocking components of a system that consistently concentrates wealth upward. Researchers have attempted to model what would have happened without these interventions. What if the Federal Reserve had not implemented quantitative easing? What if interest rates had been higher? What if bailouts had been structured differently? The counterfactuals are difficult. Economic models require assumptions. But several patterns emerge consistently across studies. First, without intervention, the financial crisis would likely have been deeper and longer. More unemployment, more business failures, more human suffering. This is important. The critiques of wealth extraction mechanisms aren't arguing for no intervention. Second, alternative policy designs could have achieved stabilization with different distributional outcomes. Equity investments instead of debt purchases. Mortgage relief for homeowners instead of bank bailouts. Progressive taxation of windfall gains from monetary policy. Tighter restrictions on revolving door employment. These alternatives existed. Third, the current framework creates moral hazard that increases the likelihood of future crises. If banks know they'll be bailed out, they take excessive risks. If regulators know they can move to lucrative industry jobs, they regulate lightly. If policymakers know they can socialize losses and privatize gains, they face weak incentives to prevent bubbles. The system doesn't just extract wealth, and this is where we arrive at the most troubling conclusion suggested by the research. The wealth extraction machine isn't an accident. It's not an unfortunate side effect of necessary policies. Many analysts argue it's a fundamental feature of the modern financial system, a system where central banks and large financial institutions operate, where crises provide opportunities for intervention that consistently benefits certain parties, where complexity obscures mechanisms that might provoke public resistance if clearly understood, where the language of stabilization and economic recovery provides political cover for transfers that would be indefensible if proposed directly. If a politician stood up and said, "We're going to transfer $500 billion from middle-class savers to wealthy asset holders," the proposal would fail immediately. But implement negative real interest rates. Implement quantitative easing. Describe it as monetary stimulus. The same transfer occurs, and it happens quietly, gradually, with technical explanations that most people don't understand and don't have time to investigate. Consider the trajectory. Wealth concentration has accelerated since 2008. The response to the financial crisis involved unprecedented monetary expansion. The response to the COVID-19 pandemic involved even larger expansion. Each crisis provides justification for intervention. Each round of concentration increases political influence. Each increase in political influence makes the next intervention more likely to follow the same pattern. Critics of this framework argue we're witnessing the largest wealth transfer in modern history. Not through taxation, not through legislation, through monetary policy and financial regulation, through mechanisms that operate below the threshold of public awareness, through a system that presents itself as technical and apolitical while producing profoundly political outcomes. The question isn't whether these mechanisms exist. The research confirms they do. The question is whether they're intentional or inevitable, whether they could be designed differently, whether the public understands what's being done in their name. Because right now, while you're watching this, the machine is running. The wealth extraction continues. The concentration accelerates. And the people who operate the system are telling you it's for your own good. That there's no alternative, but maybe, just maybe, it's time to ask whether that's actually true.